Okay guys, we're going to talk about why chasing return on investment doesn't necessarily always give you the whole picture and why it's a little bit more complicated than that. Typically when I sit down with people and talk about investments, that's the first thing out of their mouth. Hey, well, what's the return on investment? And then they try and compare what the return is from one investment to another as if that gives you the whole picture. And it's a little bit more complicated than that. So why should you listen to me? So I'm a self-made millionaire at the age of 39. If I restructured my rental portfolio, I could be retired within 12 months. And it wouldn't matter if I lived to 70, 80, 90, 150 years old, and it wouldn't matter what the stock market did at that point. I would be good. I could be completely done working. Founded 3 multi-million-dollar companies as well when it comes to real estate, working on the 4th now. So I know just a little bit about it. I've been investing full-time for over 15 years in the real estate space. So when we talk about chasing ROI, there's a couple key things in play here. One of the interesting first things, and I am not a financial advisor, so if there's a financial advisor person here and are listening in and I'm using the wrong words for this, my apologies. I'm just gonna keep it real and explain it the way I understand it. So there's fixed investment returns and there's variable investment returns, okay? What I mean by that, like in the real estate world, you can invest into debt. And what the debt is, it's basically a loan for an investment deal. No matter what happens to the deal, if it goes up, down, or sideways, as long as the borrower keeps paying you, as long as they don't default, you get that return, okay? So that's a fixed return. Variable would be like investing into the stock market, investing into the S&P, where one year it can go up, the other year it can go down, and you're kind of tied into what the overall market is doing, okay? If I was a high net worth individual making great money, great income, and I had $250,000 to invest, and I decided, you know what, in 1992, 30 years ago, I decided to put $250,000 into the S&P, and that was all I was doing. The average annual return on the S&P over the last 30 years was 10.7%. If you Google it online, that's at least what I've found. What's fascinating about it is because the S&P is a variable investment, if you put $250,000 a year into the S&P, you'd have about $42 million, okay? Now, if you flip that around and you say, you know what? I know some years S&P gave like an 18% return. Some years it was a negative return. If you take out that variability, what happens, and you just went up 10.7%, and you just matched that average annual return, what you'd have at the end of the day is $57 million. So we have what should be the same return, right? And if I'm only chasing return, I'm only chasing yield, and I'm not weighing in, is there a variability? Is there a fixed? You have two completely different outcomes. Why does that happen? Let's take $100,000 for the simple math. And let's say that $100,000 declines. We're day trading, so we're doing an investment strategy that we have all sorts of ups and downs. In a year, we go down 50%, so that $100,000 becomes $50,000. It was a decline of 50%. The next year, we have a much better year. We actually end up hitting it out of the park and we increase our return by 50%. So we increase our return by 50%. So what's interesting though about this is 50% of $50,000 is only $25,000. So at the end of the day, we only end up with $75,000. As I've talked to a lot of people investing, what I've come to find is people that are building their wealth get very fixated on what these returns are, and I'm going to try and maximize it, and aren't as necessarily concerned on the variability of it. This is a general rule, this isn't everybody. And when I've talked to and when I met with very high net worth individuals that already have a tremendous wealth, they're much more concerned with capital preservation and the certainty around the returns because they know what's going on here. Like if you do have a bad investment, you're really behind the 8 ball and really have to kick it into gear to just caught up with something that was quote unquote a lower return on paper that was performing for you the entire time. So when it comes to investing, I can really only share with you how I see it and what's worked for me. There's a lot of different ways to do it. There's a lot of different opportunities out there. I come from a baseball background. I played a lot of baseball growing up, and I actually, after college, when I would get done with real estate, I coached varsity high school baseball for about 8 years. I didn't actually understand the baseball swing. When I got done playing in college, I started studying it because I had a coach. And what's interesting on the baseball swing, if you want to hit a home run, the professional athletes, the guys that are hitting the 400 plus foot home runs, they look a little bit different because of when they set up at the plate, they're all doing a little bit different style. Their hands are in a little bit different spot. Some have an open stance, some have a closed stance, some do a high leg kick, others do a short leg kick. But when you boil it down, when they actually swing to hit a home run, they're all doing the same thing at the same time to really launch that ball out of the air. And when I think about investing, I also think about that there's a time in a season and a sequence and an order in which I feel like people should do things. So in baseball, the hips go first. You swing with your body, you rotate with your body, you plane the pitch. If the ball's coming slightly down, you swing slightly up so that you can maximize the amount of time you can put the barrel on the ball. And then you finish with your hands, keeping your hands inside the baseball. Those are the principles that if you break down any professional, whether it's Albert Pujols or any Hall of Fame swing, they all use these exact same principles. So when it comes to financial wealth, what I believe in when it comes to what the best thing is for your retirement, what I think is a little bit interesting is it doesn't necessarily always involve what the ROI is, okay? I had in my 20s, I had a very hard time having cash sit in my bank account. Really one of the first foundational plays is to have cash reserves, okay? Because in the game of financial wealth, you can't get knocked out. So if you have cash reserves, the amount is up to you really, what you're comfortable with. It's nice to have 6 to 12 months. You can figure that out what your lifestyle is for yourself, but I viewed this in my 20s, I viewed it as something that I'm not getting an ROI on. Oh my gosh, it's just sitting there, I'm burning money. When this is actually giving you, it is working for you. It's working for you to help you be less stressed out. It's working for you in the case of some emergency or something that comes up. You have cash reserve you can kind of just dip into and take care of yourself, not get knocked out of the game and have to sell an investment that you really shouldn't have, okay? So the first step is to get the right proper cash reserves in place when it comes to investing. Now the second step that's helped me set myself up for retirement by the time I'm 40 is cash flowing real estate. So I focused first on my foundation, okay? And then once I got my foundation in place, then the final step that I've been blessed and able to do here recently, investing in stocks and some of the traditional methods. And then also there's private equity fund deals and structures like that where you can invest into companies. For example, I put some money into a pharmaceutical company that's doing some amazing things to take my investment and give me a 1000x return. And I'm also not aware of if maybe there's a different company out there that invented a drug that was a little bit better. So I could also lose all my money. But because I have my foundation in place first, if I lose all that money, it doesn't matter. It's not going to impact my retirement. I'm not going to be stressed out about it. So I'm able to set up my foundation and then go after a big play. That's not going to ultimately make or break me. So this is the sequence that I really feel like you get yourself a foundation of rock with having some cash reserves and having assets that are outside of the ups and downs of the stock market, that you're not at the whim of that you have actual diversification out of it and that are bringing you passive income, because retirement's a cash flow problem, guys. It's not a nest egg problem. So this is what's worked for me personally. And as far as investments into private equity deals and things like that, investors that really have made historically the most amount of money, have invested into companies and into assets and in investment classes before everyone else knew about them. So if you think about the crypto world, for example, that's the most recent crazy example. When everybody heard about it, it was kind of too late. The guys that really made a lot of money were the guys that were investing in it 5, 10 plus years ago. Those are the guys that made tremendous wealth. I look at Amazon, the first venture capitalist company that invested in Amazon took an $8 million investment. They turned it into $1 billion. Now, when you analyze and when you look at venture capitalist business models, they're financially set up to invest in, for every 100 companies they invest in, the goal is for 1 or 2 of them to pan out and get them that crazy return like the Amazon did for that initial VC firms. You can't hit that maximum upside. You can't hit that home run, so to speak, unless you have the foundation really set up first in a solid way, to where you're not really putting anything in jeopardy. You're really kind of going for that Rockefeller-esque wealth at that point. All right, guys, we'll really appreciate your time and attention. Thank you so much for it. Here at the Passive Wealth Show, my goal is to help you as a high income earner transition from working hard for your money to having your money work hard for you, so that one day you don't have to. Thanks a lot, and make sure you check out some of our other content.